Okay, we've got some earnings, and they're going to hit basically right now. Applied Materials is out, Redfin coming up, DoorDash shortly thereafter. Renita Young and Kevin Green are with me, our senior markets correspondents, to take us through some of these numbers. Renita, Applied Materials, the first out of the gate. The market could really use some help after that really ugly close. AMAT's trying.
It's trying, but it might be better tomorrow morning because the company beat when it came to earnings and sales. And also, one key metric, I haven't even seen it yet because it's just come out in the past 2 minutes, but I'm looking forward to seeing what the guidance is for. That was the huge tell of whether or not this company believes that it'll do well, obviously. It is, as you appropriately put it a few minutes ago, the chip maker to the chip makers. Its main customers are Taiwan Semiconductor, Samsung, Intel, and it also has solar panels in its portfolio. So that'll tell whether or not, since this covers a wide variety of chip making, that'll tell whether or not this industry is going to do well or worse throughout the year. It'll give a little bit of a better indicator.
Totally. Very important stock at $100 billion market cap compared to Lam Research and KLA-Tencor. It's the biggest of the three among those chip maker suppliers. So should we take them very seriously, Kevin, or is a little changed move basically in the aftermarket not giving us any special insight? All right, no, they're up $2, so.
Yeah, we are seeing a lot of volatility in the stock in the after-hour session here. You already talked about the earnings beat on the top and bottom line. It actually does look like their guidance was better than the street's expectations here, Oliver. But they do make some comments about their guidance moving forward. They are a little bit cautious because of some potential write-downs that they might have to have or some adjustments with some of their suppliers as well. So it is kind of very interesting. When I'm looking at the earnings, we are seeing a lot of contraction when it comes to their gross margins and operating margins if you compare them to what they performed in 2022 to 2023. In 2022, the operating margin for this quarter was at 31.5%. For this quarter, it's at 29.2%. So there's a contraction there. You really don't want to see that type of scenario play out. And then you also have to just think and keep in mind, this company here, they don't actually make the chips themselves, right? They create the equipment for these fabrications. So when we have a supply glut like we did, the first thing a lot of these semiconductor companies did was inform their customers, hey, work through your inventory. They're calling it undersupplying, but they're basically forcing the customers to work through their inventory. Once they do that, these semiconductor companies are going to then ramp back up with the existing equipment that they have, and then once they meet that capacity, that's when they are going to then purchase new equipment to expand operations. So it might take a little bit more time for this company to see a nice spike in demand. When you're looking at some of the other semiconductor companies that have already reported, they're saying that the supply should be back in line by the second half of this year. That would make it seem like maybe the first half of next year would be when AMAT and a lot of these other equipment manufacturers would actually start getting a little bit of a boon when it comes to demand. But the street is liking some of the commentary here at this point in time. Let's see how this actually pans out through the rest of the trading session here.
All right, good stuff. Well said. Very important company. I like the context, too, on how they responded during the supply chain pinch. Let's talk Redfin, Renita. When we are in a period of companies showing profit, many of these tech companies for the first time, that would be amazing for Redfin as they just burn through money, but that is not going to be the case. Another loss on the bottom line. It was a smaller loss, though, right? But they still are, I mean, they just rip through cash.
They did, you know, and so one of the indicators of how Redfin would do came when Zillow reported, and Zillow gave a pretty stiff outlook. You know, the outlook, it called for industry traction to drop, for the dollars to drop by as much as 35% from a year earlier in the first quarter. And so we can see that Redfin fourth quarter revenue was at $479.7 million. Earnings per share was a loss of 57 cents for Redfin. And it really just shows you who has the power and who doesn't. You know, this is in the hands of consumers who homes have not become as affordable as they once were. They've become less affordable because of rising interest rates, because of base house prices as well. If you get into the detail of it, you'll see that homeowners or taxes have also risen as well. And so that all impacts your mortgage payment, and it all impacts folks' ability to be able to buy a home on Redfin and their bottom line. So revenue growth was actually not growth. It was a contraction of 27.4% for the fourth quarter, and gross profit margin was at 7.8%, when you could see the year before it was almost double that. It was more than double that, so rough. The company spent more money on its tech and development expenses, and operations income was at a greater loss this time around than it was the last time.
Boy, that looks like a bad report to me, Kevin Green. Am I missing something?
No, this is a pretty bad report here, but they are trying to make improvements. They actually did shave off a few of their workforce employees here earlier in the year, or later last year, if you will. So they're trying to get ahead of this, Oliver. And yes, we now are seeing the reaction in the aftermarket, where it is starting to trail to the downside here. They did provide better than expectations when it came to their guidance, but one thing to just keep in mind with Redfin and their pricing model, everything is static. So real estate agents or what have you, they don't actually have a lot of pull when it comes to the amount of commissions that they're going to charge for a home. It's just a flat rate. And that's something that might make Redfin a little bit at a disadvantage in the marketplace. Renita just talked about it right now. Right now, the prices are still elevated. So one, the rates are going up higher. There's not a lot of people buying houses. What's going to happen with those real estate agents in those homes? You're going to try to get as much money as you possibly can, because it's going to be harder to sell a home as well as buying a home. And if those homes actually do decrease in value as we start seeing this correction and unemployment goes up, then you also have a situation where the value of a home goes down, and then that rate that you have, the commission that you make off of that home, also goes down. So it's a double-edged sword when you're talking about Redfin. They're trying to make as many adjustments as they possibly can, but if you compare it to another company like a Zillow, they might be at a disadvantage from a model standpoint, not so much from a financial standpoint, but the model itself for implementation is going to be pretty hard in the near future.
Just to be specific there again on that, because I think that's really important, because I'm sitting here wondering, Redfin, Zillow, I mean, there's other sites too that are less popular, and some of them are also co-owned, but is there tie-up? Is there a merger? You're saying that Redfin versus Zillow, there are some slight differences here that might show up?
Yeah, I mean, yes. So with Redfin, and don't completely quote me on this, but this is the last quote that I had. Redfin, when it comes to the real estate agents, they charge between 1.5% to 3% of the sell price, and that's pretty much capped. Right, so that's what they're splitting up between everybody that's involved with the deal. They cap that. That's a part of their model. They want to be transparent with their pricing. Well, guess what? If I'm a real estate agent and I'm a really good agent, Oliver, right, I'm trying to get as much money as I possibly can, especially in an economic slowdown. I need to sell as many homes as possible. Now, I can do that two ways: selling a lot more homes, which is difficult if you don't have buyers, or I try to sell homes that are at a higher price, higher value, and I can up my commission structure as well. That's where you start having a little bit of a difference. When it comes to Zillow is more of like an advertising site for homes. You can connect with agents, whereas Redfin, you're actually doing the deal with Redfin and that real estate agent. And once again, you're capping that. You're capping the commissions. They're capping their own commissions or their own revenue that Redfin can actually make as well. They're capping it, so they're not giving themselves a lot of movement to the upside and or downside if they have to adjust for a changing market environment. I think the street would appreciate it if they came out and said, hey, we're going to have a flexible pricing structure in order for us to be a little bit more dynamic. That would drive revenue to the top side. That could also offset some of those losses. That's what investors want to hear.
Okay. Great stuff. Like that comparison. Let's talk some DoorDash. Also a troubled fundamental balance sheet picture that market is giving a new look at right now. Despite a big loss, they're buying back shares. Apparently that's a winning strategy. What stands out to you here, Renita? I mean, this is a pretty big move, up more than 10% in the aftermarket.
Now, one thing that heading into this, I was looking forward to finding out was about cost. And because the company might have been creating or having higher expenses because it might have absorbed more costs associated with the latest acquisition, the European food delivery company Wolt from last year. But also, additional costs might be possible since back in November, New York City regulators proposed a rule to pay pay delivery workers a minimum per hour rate, and that's not counting tips for their time spent driving and on call. And so it's interesting to find out if they were able to do any of that. But for now, you can see adjusted earnings per share was at a pretty steep loss of $1.67, and revenue came in just above estimates, or a little bit more than just above estimates at $1.81 billion. But so far, the company is seeing that DoorDash monthly active users for the fourth quarter was at 32 million. And it sees for the first quarter of this year marketplace governance of $15.1 billion to $15.5 billion as well.
The outlook for revenue, I guess maybe here is some kind of silver lining to some degree, with an outlook there that might be better than some of the expectations. Get that they're increasing monthly active users to the 32 million at the end of last year, which was 7 million change throughout the entire year. However, that being said, the bigger than expected loss on the bottom line, I mean, how does that not just grind this company down eventually, Kevin?
Well, if you look at some of the prospects with the new businesses that they're trying to get into outside of just the restaurant delivery side of the business, now they're focusing on gas stations, liquor, grocery stores, things of that nature. If you actually look at the growth rates for those smaller segments, they are actually pretty healthy at this point in time. So they are seeing some growth there. They also had that Walt business over in the European Union as well. That's also driving a lot of growth and a lot of anticipation. And once they can figure out or complete that type of integration there, they'll also have some synergy on the cost side as well to be able to focus on. One thing that I'm just kind of a little cautious about when it comes to these delivery companies at this point in time is you start seeing the cost of the eating food outside of the home, right? That's a CPI item that continues to rise at a pretty rapid clip. So at some point in time, you might start seeing the consumer shift that and actually start eating at home. And a lot of those fee revenue, or a lot of that fee revenue that they've been able to capture and really offset some of the costs when it comes to the dashers, the actual delivery drivers themselves. That's how they've been able to offset some of the operating costs there. If you are challenged in that environment when it comes to pricing, that could also just have a negative impact here. But the street is liking this report right now. The stock buyback, I think, is a little bit more symbolic. $750 million. If you kind of think about it, it's not that much money, but it is more of a symbolic move. It provides the confidence in the marketplace to say that, hey, we believe that we can be able to do more for our shareholders, and that's what investors really want to see.
Well, the previous way to use money to try and flip homes didn't really work out. So I guess to just buy back the shares instead. Hey, being rewarded for it, following suit with what the market has prioritized here. Great stuff, guys. Renita Young and Kevin Green.